Okay, chapter 11. More payroll tax stuff. Last chapter, chapter 10, we talked about how to calculate payroll, how to do the payroll register. Tonight we're going to do the back end, the business end of it, calculating the taxes that the employer has to pay and how to make the payment, right? Because if we're withholding money from the employee's check, we don't get to keep it. It has to get paid to the government, correct? Okay, yes, sir.
This is relating to the question I asked you earlier about the department. Wouldn't you also charge the back-end taxes to the departments as well?
Yes. I was making it simple and just showing you. Yeah, okay. Okay. All right. All employers have to take the money that's withheld from employees' checks and remit it to the government. Either the federal government in terms of Social Security, Medicare, federal income tax, or the state in terms of state income tax. It used to be referred to as making a payroll tax deposit. In the old days, you would write a check and take it down to your bank with a little coupon that said who you were, and you would give it to your bank and they would send the money to the government. That takes too long. So a handful of years ago, the government started making you do it electronically. You get on a website where you've already connected your bank account to it and you tell them how much and push the button and the money moves now. Okay? So if someone says, I've got to make a payroll tax deposit, you don't go to the bank like you used to in the old days. You're doing it probably electronically. Let's see. Social Security, Medicare, income tax. Remember, we withhold Social Security and Medicare taxes from the employees' checks, but on both of those, remember that the employer matches the amount. So when they make the payment of the tax to the government, they have to include the employer's share of that as well. Okay? This is kind of old because it still says that businesses make their payroll tax deposits at their own bank. If you walk into your own bank and try and do that now, they send you away. All right, how often do you have to make the deposit?
Every quarter.
Well, it can be every quarter. It depends on how much gross wages you have. If your company has a little bit of gross wages, they'll let you do it every quarter if your payroll liability, if the total that you owe is less than $2,500. If you owe a little bit more than that, they want you to pay it every month. And if you owe more than that, they want you to pay it within 3 days of when you wrote the checks to the employees. Okay? They use what's called a look-back period. In essence, they look at the previous year and they see which of those 3 categories you fall into, and they tell you you're a quarterly, monthly, or semi-weekly, I think it's called semi-weekly depositor. Okay? So they look at the prior one. The tax liability threshold is still $2,500. If you owe, anytime you owe more than $2,500, they want it right now. Most taxes, all your taxes now are paid through this electronic federal tax payment system, EFTPS. Government has an acronym for everything, right? All right. So in determining how often you pay your tax, you start with that $2,500 number. If you owe more than $2,500, let's see, is it less than $2,500, you only have to pay it once a quarter when you file a quarterly payroll tax return. If it's more than, you've got to look at that look-back period and figure out how often. The important thing to get from this slide is that there's a quarterly payroll tax return we have to file, right? You and I as individuals, we only have to file our tax return once a year, April 15th, right? Businesses have to do it every 3 months for their payroll, for the wages that they paid of all of their employees. So there's a lot of work there. All right, so the threshold, and I believe this is still true, even though this is an old slide, is $50,000. In your look-back period, the previous year, did you have gross wages of more than $50,000? And if you didn't, then you only have to pay semi-weekly, every 2 weeks. So you're making a deposit for your taxes twice a month. If it's more than $50,000, you're what's called a monthly deposit. I'm sorry, am I reading this backwards? Is it less than $50,000, you only have to pay once a month. If it's more than $50,000, you got to pay every 2 weeks.
Isn't semi mean half?
Semi's half. I just said every 2 weeks. I apologize. So twice a month, 1st and 15th. Thank you.
Semi-weekly. That would be within 3 days.
The semi-weekly is within 3 days. So there's 3 things, and I thought they were going to work us to the third one, but they're not. I apologize. If your look-back period's less than $50,000, you pay once a month. Okay? If your look-back period is more than $50,000, you go right to the semi-weekly, meaning you have to pay it 3 days after the payroll checks are written to the employees.
So that's gross wages or total taxes collected?
Gross wages.
$50,000.
Is nothing.
Employee.
It's nothing.
Yeah.
So most people are having to pay it. If you pay your employees every Wednesday or every Friday, by the following Wednesday, you're making a payroll tax deposit. Okay? I mean, they're serious about getting the money. Why would they be so serious about getting the money?
Because they need money to spend.
You think maybe they have a cash flow problem?
Yep.
Okay.
Is that why a lot of companies pay on Fridays, or most companies? So they have the extra weekend?
No. Being paid on Friday is an old thing. It goes way back before any of this electronic stuff. And I believe, I don't know this for a fact, but I believe it has to do with, if I pay my employees today, they probably won't show up to work tomorrow. They're more likely to not show up to work tomorrow, right? If you go back far enough where everybody was manual labor and they were working hard, Fridays tend to be the night everybody goes out and has a few beers and whatnot. Are you coming to work the next morning? Maybe not. So we'll just wait and pay everybody right before the Saturday when they don't have to come to work anyway, and then we don't have a problem. I think. Just an opinion. I could be wrong. Okay. Remember that the employer matches the Social Security tax. So when you're calculating, if you're the employer and you're calculating the payroll tax deposit you have to make, you take what was withheld from the employee, you match it for Social Security and for Medicare, you match it. Total those, add them together. Those two together is $343.86 in this example. What's the one thing that's missing to calculate the total employer deposit?
The unemployment tax.
Unemployment. That's a separate tax, but the one we're missing is the income tax withheld from the employees. You would add it to this, and that would be your total deposit for this. When you do the federal unemployment tax, that's a separate deposit, but that's an employer only. There's nothing deducted from the employee, and the employer pays it 100%. Good? Okay. I want everybody to remember that the employer is matching on these.
But they don't match the income tax.
They do not match the income tax. Okay. So, I'm going to go back here. Think about this. We recorded this liability as a payable on our payroll register, and this one for the Social Security. Have we recorded the employer's liabilities? No. We need to do that. And when you make that payment is the time to do it. So you increase the payable for Social Security, you increase the Medicare tax payable, and you debit payroll tax expense. Now here's the first time we've seen the payroll tax expense. When we recorded the wages that we have to pay from the payroll register, did we have a payroll tax expense account? No. It's only for the employer's part of it. Okay? Questions on that?
Only the employer part, right?
Only the employer's part goes in payroll tax expense. So, yes?
So when the payment goes out, then you credit back to these accounts?
Well, this is an expense. You would not credit this,
No,
but you would debit here
yeah,
and debit here and credit which account when you make the payment?
Cash.
Cash. Cash would go down. And the balance in those two accounts would go to 0. Okay? I think we're going to see that here in a second, though. All right. Okay, here's a better example because they include the federal income tax. This company is calculating their payroll tax deposit for the end of January. Employee withheld from Social Security, for Medicare, for federal income tax. The employer matches the Social Security and the Medicare. Okay? Total withheld from the employee, total paid by the employer. Total deposit is how much? The two of them added together, right? Okay. So how much cash is going to go out the door? The $1995.44, correct? Okay. So when we record that, you would debit Social Security payable, debit Medicare payable, debit employee income tax payable, and you're going to credit cash. Notice, here's what was withheld from the employee, the employer matches it, and the total. Notice that becomes the balance of your payable, and by debiting it, when you make the payment, the balance goes to what? 0. Good. Questions? All right, let's... Okay, questions, anybody? All right. So remember I said that the employer has to calculate and file a quarterly payroll tax return. Quarterly is every 3 months. So at the end of every 3 months, you take the individual earnings records and you add them all up and you get the amounts that you need to report on the tax return. Okay? It's pretty straightforward. Because it's a government form, it looks real official. People get nervous about it. Don't. It's really straightforward, okay? And we're actually going to have a look at one. The payroll tax return for the federal government is called a Form 941. Every tax return or document that you file with the IRS always has a form number. They give them names too, but they refer to them by form numbers. So it's a 941. It's due at, so let's say the first quarter is January 1 through March 31. The tax return is due the last day of April. Okay? Second quarter is April 1 through June 30th. It's due the last day of July. Piece of cake. There's 4 quarters in a year. They talk about this rule where if you deposit all your taxes on time, you can take an extra 10 days to file your return. I don't ever count on that. I just do it. Get it over with so you don't make a mistake, right? Just in case. This is a straightforward copy of the top half of a Form 941, the federal income tax return. All the income tax forms for employers are relatively similar. They always start with, who are you? What's your number? What time period is this for? Okay? Always, always. Then they come down here and they ask you, what's the total of all the wages you paid everybody? What's the total of all the federal income tax you paid everybody, or withheld from everyone? What was your total Social Security wages? What was your total Medicare wages? Remember when we were doing, I'm going to go over here. Remember when we were doing the payroll register, we calculated the taxable wages for Social Security and Medicare. That's where those numbers come from. But you're going to total the payroll registers for the whole quarter, the whole 3 months, and those amounts end up going here. And then they recalculate at the full rate how much Social Security tax was owed. Now notice, what's the Social Security tax rate? 6.2, right? But they put in here on the form 12.4 because it's the employee's part and the employer's part that you should have paid. Same thing with the Medicare tax. Instead of it being 1.45, they used the employee and employer at 2.9, and the total you should have paid. Now, was that your question, or?
No, I was going to ask you, why is the total wages different from the tax bill? See, that's 29,217, and you have 25.
Okay, this is the amount of federal income tax that was withheld. So the total wages were $29,217. We withheld $2,015 in federal income tax from all the employees. And then both the employee and employer's part of the Social Security tax and the Medicare tax. And you add them up and you get total taxes due. Okay? And then the bottom half of the form says all the payments that I made, and do I have a balance that's due, or am I owed a refund? And that's really all there is to the form. Pretty straightforward. You guys are now experts. You can all do this. Yes?
I'm confused.
Okay, tell me why.
Okay, so we're filing this quarterly, what are we filing weekly or semi-weekly?
Nothing.
Oh, so
We
it's
only-
either or.
No. I think you're confused.
Oh,
We calculate the payroll register for the time period that we pay our employees. If you pay your employees every week, you do a payroll register every week.
yeah.
If you pay them every 2 weeks, you do it every 2 weeks. And then you calculate your payroll tax deposit based on your deposit schedule. Assume it's the 3 days, which it most likely will, right? So if I pay my employees every 2 weeks, so say tomorrow's Friday the 10th, it's a payday. By next Wednesday the 15th, because it's 5 days with the weekend, I have to make the payroll tax deposit. And that was where we were calculating the total deposit that we have to make and recording the employer's part of the payroll tax. Okay? Then once every 3 months, we don't have to record anything in our general ledger. All we're doing is taking the information from our payroll registers and reporting it to the government. And the whole point behind this is to prove to them that we paid in the amount of money that we were supposed to.
That we did the deposits.
Right.
Okay.
So we withheld this from employees. We owe this for Social Security. We owe that for Medicare. Here's the total we owe. List your deposits. Calculate if I owe or not. Hopefully it's 0. If you owe, send in a check. If you don't, we're good. And that's all that this Form 941 is for. Good?
Yeah.
Okay, go ahead.
Are there often like errors sometimes that you pay too much than you were supposed to? Or-
Sometimes we can make a mistake calculating how much we're supposed to pay, and we'll overpay or we'll underpay. Because you're doing a ton of calculations. In the old days when it was all manual, making a mistake was not terribly uncommon. Computerized systems now, they should be pretty dead on. All right? Should be. If they're not dead on repeatedly, I would figure out why. Other questions? Okay. All right. The other government filing requirement that every business has is at the end of the year they have to send every employee a W-2 to figure out their income taxes. It's not for the benefit of the employee specifically, because you have to send those into the government as well so that they know how much income tax to expect the employee to pay with their tax returns. Okay? It's kind of like your employer is telling the government too much about you. Kind of. So a W-2, every W-2 requires a W-3. I misspoke. Let me clarify. Let's say that we had a company with 600 employees. Okay, we would have 600 W-2s to fill out at the end of the year. When we submit the W-2s, the whole stack of them, to the government, they need a cover sheet. The W-3, you need one W-3 on top that just shows the totals of all of the numbers on the W-2s, all 600 of them, and it's the cover sheet that goes with it.
So it's just basically a report,
Yeah,
summarize.
it's the cover sheet for your TPS report, yes. Okay? All right. Here's a simple W-2. This is kind of an old one. They've changed a little bit. Everybody seen one of these? Hopefully. All right, so who's the employer? What's your number? Who's the employee? Where is it? What's their number? How much wages did you pay them total? How much Social Security wages? Remember how we broke out Social Security taxable? How much Medicare taxable wages? Federal income tax withheld, Social Security withheld, Medicare withheld.
Isn't buy redundant of one always?
Yes, it is.
Okay.
If they ever put in a Medicare floor, they will not be redundant, but for now, they are. Down here, they've set it aside for state wages because this gets reported to the state you live in as well. So what's the employer's state ID number, and what was your state wages, and what was your state income tax withheld? Notice there's nothing there. I'm disappointed. They didn't have anything withheld, but it would go down here in this box. Good? Pretty straightforward. And all that comes off of your individual earnings record that we talked about. Remember, it goes from the payroll register, and you pull that out and you put it on everyone's individual earnings record, and you total it up, and that's where the numbers go. Good? A W-3 looks the same, except it doesn't have an employee name, and it totals up that box for all the W-2s and plugs it into that box. I think we're going to see one here. Here you go. Here's W-3. They look almost identical, and you're totaling up all the boxes. Good? Questions? This is fun stuff, right? Okay. All right. Unemployment taxes. Remember the federal unemployment tax and the state unemployment tax, FUTA and SUTA? And then that semi-tax, workers' compensation, but it's an insurance, it's not a tax, right? Let's talk about those. Because if the government wants you to file a 941 every quarter to show how much income tax and Social Security and Medicare was withheld, they probably want you to file another form to show how much federal unemployment tax is due, right? You only have to do it once a year, though. The state asks you to do it also, so you're filing a state and a federal unemployment tax. I'm just going to cover the federal one. Everybody owes federal unemployment tax, but the feds allow you to have credit for the amount that you pay to the state for unemployment tax. Just so you know. Let's kind of walk through that here. Remember the federal unemployment tax wage floor was how much? $7,000? So you're only paying unemployment tax on the first $7,000 in wages for each employee. And after that, you don't have to pay in anymore for that particular employee. So once all of your employees go over $7,000, assuming you don't hire any new ones, you're done paying for the year, right? Good. The federal unemployment tax rate is 0.8%, not 8%, not 0.008, 0.8%, which is 0.008 in decimals, like it shows up here. Okay? So make sure you use the right amount. It seems like a small number. The reason being is that they assume that at that rate that you've already paid in the full amount to your state government. So if you're not paying into the state for state unemployment tax, this rate goes up. Okay? In California, you have to pay it in, so we're using this rate. Clear as mud? Okay. The example is based on Texas. So the state unemployment rate for Texas is 4%. In California, it's 5.4%. It's more. Okay? Just because it's California.
Isn't it less for small businesses, for new businesses? It's like 3.2, right, when you start a new business?
It's based on your history. So if you hire a lot of people and you lay off a lot of people, your rate will go up to that maximum of 5.4. If you're a brand new business, it will start at 3 point something, and it will go up to 5.4 very quickly, because they've set it, it's kind of rigged where it's just going to go to 5.4, I believe. Again, my opinion, but I've seen it happen to everybody. So I just count on it being 5.4. So you can do the calculation. It's the taxable wages, right? Just like we calculated the taxable Social Security wages and the total and the taxable Medicare wages. Remember from the payroll register, there was taxable FUTA wages. Okay, everybody remember that? So you take that total, and that in this example is the $2,247. Multiply it by the tax rate, bang, you calculate the amount. We haven't recognized this in our general ledger anywhere, so we're going to record it as payroll tax expense and the liabilities to both the federal and the state. Simple entry. Pretty straightforward, I hope. Questions on that? Anybody? Any questions at all?
Why does it say that unemployment taxes on weekly payroll?
Because we must pay everybody every week.
Oh,
Okay?
I was reading it in another way, like saying it was put on the weekly paychecks or something like that.
No. These guys may be, that's the total wages for this payroll register, so they're calculating this every week and recording it. Okay? Good. So here's another one that, per your question earlier, you would calculate this every time you do a payroll register and make this entry to record the expense.
Up to $7,000?
Each employee to $7,000. So if you're in December and you hire a brand new employee, they're at zero, so you're still going to be calculating this.
Does state unemployment have a limit as well as federal?
It is also 7,000.
So it's 14,000 total?
No.
No. Okay.
They're both on only the first 7,000. So you're paying, in this example, you're paying 0.4% to the state, and you're paying 4% to the state and 0.8% to the feds, a total of 4.8% on the first 7,000 in wages for each employee. Okay. Yes, ma'am. Anyone else?
Like I've seen on some W-2s, they know that locality taxes, like local taxes.
Yes.
Where would that?
Since 16 is early, right?
Okay, that's back over here on the W-2. You'll see locality. Like if you live in the city of New York, they have an income tax. And this is set up for that. So it would say New York City and the wages and how much was withheld.
So that's kind of like the same as state
The same as what?
tax?
It is the same as a state tax. It's just the city's charging one also. The state's charging and the city's charging.
So the employer, will the employer make payments for that, or?
The employer has it deducted from their check, and the employee has it deducted from their check, and the employer sends it in when they make those payroll tax payments.
So that's an additional paperwork?
Yes, it's more paperwork for the employer, yes. So that's why running a business in New York's a little tough. Okay? All right. So moving right along. So we calculate this every time we do a payroll register and make payroll and record the unemployment tax liabilities for both federal and state. Good? All right, remember that it's only earnings on the first 7,000. Once the employee goes above that, you don't calculate it anymore. Their taxable wages for that period become 0, right? And we're going to go through this really cool example of showing you. Here's an employee that earned $2,200 in January. Their cumulative earnings are $2,240. All of that's taxable because it's under 7. When you get to, look at what happens. This guy gets a really cool raise. In the whole month of January, he makes $2,240. In the whole month of February, he makes $2,240. The first week of January, or March, he makes $2,240. His pay rate just went up, by a factor of 4. And then it goes back down. Yeah. So notice at this point, his cumulative earnings are $67.20. He makes another $560. His cumulative earnings go to $72.80, but only the first 7,000 are taxable. So $280 of this check, there's no tax. Okay, you don't calculate unemployment tax on $280 of this check. Good? And in week 3 when he gets paid, none of that is taxable because he's over the 7,000. Okay, I kind of covered that over here, but just a quick reminder. All right. Making the payments for the federal unemployment tax is just like paying the payroll tax. Going to your bank is out of the question anymore. You're making the EFTPS deposits electronically. Okay, just so everybody knows. You only have to pay this quarterly. And you only have to file that tax return once at the end of the year. Remember how the quarterly payroll tax return was a Form 941? Does anybody know the form number for the annual FUTA tax? It's 940, okay. And so you true that up once a year at the end of December, and you either owe or you don't owe, and right, or they owe you a refund if you made a boo-boo. All right, just show me a return. Now, there's a 940 and a 940 EZ. If you're an employer in only one state, you can use an EZ, and it's a one-page form, and it looks like this. This is what I'm trying to get to. Here's the 940 EZ. You're an employer in only one state. Who are you? What's your number? Typical government form, right? It wants to know how much did you pay in for state unemployment and which state did you pay it to? Remember, because they give you credit, they let you pay that 0.8% because you paid into a state. What's your total wages for the year? How much of the wages were above 7,000? Subtract that from the total and you get taxable wages. When we do the payroll register, we just calculate the taxable wages, right? All of a sudden, they're doing it backwards. So let's think about this for a second. Total wages less the amount above the limit leaves us the amount that's taxable. The taxable amount times 0.008 gives us how much tax we owe for the year, $280. Okay? Then there's another line that says, have you made any payments? Write it in, calculate the difference. Do you owe or don't owe? Good? Straightforward. If they have total taxable wages of $35,000, and you assume that no turnover in your employees, how many employees did they have?
5.
What's the wage base?
5 employees.
$7,000, right? 35,000 divided by 7 is 5 employees. Okay? It's pretty straightforward. It wasn't a trick question. Was that a trick question? Yes? Okay. All right. We talked about workers' comp a little bit last time, correct? Yeah. Okay. Workers' comp is required by law. It is an insurance that every employer's got to go buy. So a lot of employers consider it a tax because it's required by law. And what it is if an employee gets hurt on the job, the insurance covers their medical expenses and some other stuff. Okay? Good? However, when you buy workers' comp insurance, it is usually sold to you, the premium that they charge, the fee, is based on how many employees you've got and how much you pay them. So it's based on total wages paid, gross wages. Good? And the other factor is how risky is your job. If you're an office worker, you pay a cheaper rate than for someone who puts roofs on houses, right? Think about it. If you're working 20 feet up in the air and you could fall and break your neck, it's more risky, correct? If you're sitting in a chair, you can maybe roll it over backwards and bump your head, but that doesn't happen too often, hopefully. Okay? So they're charged at a different rate. Like any other insurance, they require you to pay your insurance in advance. But think about it. If your insurance premium is based on how much you pay your employees, how do you pay it in advance? Because you don't know yet, right? Again, what?
I would assume they base it on the previous year, or?
Well, we make an estimate, and they have you start paying in based on the estimate, and they true it up at the back end. So in essence, they have you make a deposit up front. So you make a deposit, and then we'll true it up at the back end. So here we go. We're going to do an example. We've got a company that has two different departments: office workers, shipping workers, just like our payroll example when I did the payroll register. Office workers, how often do they get hurt? Ouch, I got a paper cut, right? I fell out of my chair. Yeah, I hit my finger with a staple. Shipping workers, a little bit more risky, back strains, they get hit by the forklift, whatever, right? Let's hope not. But hypothetically, it could be a lot worse. So the premium is probably higher for the shipping workers than the office workers. And you're going to find that that's indeed the case. They typically base the rate, well, they always, in my experience, have based the rate on every $100 of gross wages that you pay in that category. So if you pay your employees $1,000, you divide by 100, it's 10, right? 10 times 0.45 is $4.50. Everybody follow how we're going to calculate this? Okay.
You just round up to the next hole.
Yeah. Okay. Here's the book saying they came and they did an estimate and they had you make a deposit, an initial deposit of $1,000. Cool? So we prepaid workers' compensation insurance, cash goes out. Everybody's good with this entry. I'm more interested in how we calculate it and how we true it up at the end. Okay. Office wages were $24,960 for the whole year. 24,960 divided by 100 is 24.96 times 0.45 is $112.32. Would be your insurance premium for the office workers. Everybody follow me?
So they don't round.
So they
don't round.
No. No, we're not rounding. It's not like a federal tax return. I'm sorry, I misunderstood what you said earlier. Shipping wages are $91,910. Remember, they were at a higher rate of $125. So their total premium is $1,148.88. Add the two together, my total premium for the year, $1,261. Good? Yep. Remember we made the deposit? Oh, let's see. Remember they had us make the deposit at the beginning of the year? So at the end of the year, they come back and they say, hey, you owe me another $261. Okay? If they had estimated your deposit at $1,500, they'd owe you a refund. So it could go either way. Straightforward? Question?
What was it that you mentioned about like the workers' premium increasing and you have a lot of like accidents or result of that?
Well, what I said, and you're right, remember the shipping rate is $1.25 and the office rate is only 45 cents per 100. So these guys are riskier. They expect more things to happen to shipping employees. So the rate is more. Now, then they start basing it on your personal experience with your company. Okay, so if your workers never ever get hurt, they may figure you're less risky and charge you less in both categories. Or if your shipping employees are screwing around all the time and they're getting hurt and they're dropping boxes on themselves, your rate may go way, way up. All right, you may be paying $10.25.
It's like all insurance, you get in a car accident, you're ready for the
Exactly. The more claims you have, the higher your premium is going to be. So they rate you higher. Okay? And that all comes into play. But as far as you're concerned in the calculation, they're going to tell you what the rates are, and here's how you do the calculation. But the insurer tells you what the rate is. And it's your option to buy it or not. Right? No, because it's required by law. Right?
It's which carrier you go through.
It's which carrier do you end up using, exactly. Okay, so this company owed another $261. We write them a check, and on we go. All right. So some things about payroll. If you ever find yourself doing payroll for a company, the number one rule is confidentiality, right? You've got everybody's social security number. You know if they're married, you know their home address. You know, you are information central for any stalker in the company, right? Or any identity theft, any of that. All this information gets locked up and kept away from every other employee. It's not for someone else to have, okay? Unless there is a reason why they need to have it. You also, if you're doing the payroll, you typically are privy to some medical information based on which medical plans there are and things like that, all confidential stuff. Always make sure that your payroll employees are trained well. Every employee gets paid a certain amount, right? In our example we were doing, some people got paid $9 an hour, some got paid $9.50, some got paid $14. There needs to be a procedure and an approval if anybody's pay rate gets changed, right? You can't just have anybody walk in and say, hey, change Joe Schmo's pay rate to whatever, right? So it has to go through an approval process. Somebody's got to sign off saying that they approved it, and that has to be documented and sent into the payroll office before you change somebody's pay rate. Make sure you have your employees fill out, what is the form now? A W-4, right? Remember at the end of the year, every employee gets a W-2? Well, there's a form called the W-4. And this is where the employees tell the employer, here's my name, here's my address, here's my social security number, here's how many allowances I want to claim. Make sure that every employee fills one of those out, and that you don't change their withholding allowances unless they fill out a new form authorizing you to do so. Because it's, all heavily government looked at, monitored stuff, and you don't want to be accused of doing something the employee didn't tell you to do. Okay? If an employee wants to have voluntary deductions, remember we consider medical or 401k to be voluntary. Make sure they sign a form authorizing you to withhold the money out of their paycheck. Just so you cover yourself and they can't come back and say, hey, I didn't tell you to take that out. Okay? Now, we always have checks and double checks to make sure that, to create internal control so that no one can rip off the company. Have one person calculate the payroll register, and maybe they can even write the checks, but have somebody else go through and approve the checks, and even a third person sign them, so that you have those double checks in place. That way you don't have one person responsible for all payroll functions. What happens if one person is responsible for all payroll functions? Pay themselves a little bit extra, pay their buddies a little extra. Maybe you get some bogus employees that don't really exist who are all of a sudden are getting checks, right? So you want to have those double checks in place. The person who writes the payroll checks should never be the person who hands them out. Think about it. If there are bogus employees, I wrote all the checks. Here's yours, here's yours, here's yours. Oh, I got 2 left. One's mine and the other one is, well, it's mine too, right? So you want to have someone else handing them out so you see the face. Match the name with the face so that you're not paying fictitious people. Have some third person get the bank statement and do the reconciliation, because things will pop up there that they may catch. What if the first 2 people get together and are colluding on some sort of a scheme to rip off the company? That's how you're going to find it. Good? Pre-numbered checks, we've talked about that before. Payroll records are very important because they are, they're tied to everybody's taxes, they're tied to this quarterly 941, the annual 940. They can get looked at a lot. They come under a lot of scrutiny because they involve taxes. Keep good records and keep them for a very long time. Okay, very, very important. And they have to be kept confidential and locked up. You can't just put them in a box out in the warehouse. What if a bunch of employees stumble across them and start going through and figuring out what everybody else makes, right? Questions, anybody? Answers? Okay, we're good. We're good.